Good morning, everyone, or wherever you are in the world. Good afternoon or good evening, and welcome to a new episode in our webinar series. Today, we're going to talk about duty drawback. But before we go there, I'm going to take you through some housekeeping. And let's start with the screen that you see in front of you. There are quite a few widgets here. So if you look at the left, you see today's speakers. I will introduce them properly in a second. Below there, there is a widget called Additional Materials. There you can download the presentation directly after this session. Then on the, let's say in the middle of the view, you'll see the slides. You can make it bigger, you can make it smaller. Below, there is the media player. And then if you're looking at the top right, you can actually see what is next in our webinar series. So you'll see our State of Trade webinar here, but I'll talk a little bit at the end about another webinar about the UK as well. Below that, Q&A. We encourage you to ask questions. We will try to answer as many of those at the end of this session. And we always love to hear from you in terms of feedback, whether you have suggestions for a topic, whether you think that we should do something better. And we really like to hear from you. Okay, but before we go there, a little legal notice, it essentially, you don't have to read it all. It essentially means that everything that we present here is general market info, and it might not be specific to your situation. So if you want to have this customized to your situation, what you're hearing today, we highly encourage you to reach out to your customs broker or to your account manager at Flexport, and they're happy to help you learn more about this topic. All right, today, who do we have here? So my name is Sanne Manders. For those who've been in these webinars, you've seen me before. I took a little bit of a pause because we had our annual conference forward, and we didn't do that many webinars around that. But I'm back, so you'll see me more often again in the future. But with me, much more interesting, Maryana Kessel. Maryana is our sales director for enterprise customers in the East. So she serves our biggest accounts in Flexport. And she has quite a bit of experience with the drawback topic with her customers. And then most to the right, we have Tim. And Tim is our specialist. He's our expert. He's our head of drawback. Tim has worked his whole life in drawback, and he will take you through all the technical details, and also very happy to answer detailed technical questions in the Q&A session. All right, what's in it for today? First, we're going to go to the basics. What is drawback? We're going to talk about details for success, tooling for how to explore these opportunities. And we're going to talk about the real world. You know, how do clients apply this before we go to the Q&A? I am going to hand it over to Tim right now because he's the one who's credible about this. I'm going to learn as well. Tim, the floor is yours.
Great. Thank you, Sanne. So, yeah, let's jump right into it. Drawback is a refund of up to 99% of certain import duties, taxes, and fees when one of the below are exported or destroyed. And so if imported merchandise is exported or destroyed, if you're exporting similar merchandise or substituted merchandise as what was imported, if you're manufacturing products using imported components that are then exported, or if you're manufacturing products that are exported using substituted or similar components as what you are importing. Overall, drawback is a very complex program, but it is one that has tremendous benefits. And at its most simple essence, it is a refund of your import duties and fees when you export or destroy. So at a high level, if there is an import, if there is an export, there is an opportunity for drawback potentially. It's a little bit more complex than that. There's a lot of nuances. There's many different types of drawback or provisions of drawback. But what drawback does allow is, if you do meet a certain set of requirements, you can get back your regular tariff rate, so the duty that's associated with the importation of your merchandise. The 301, or what's known as the China duties, right? The 301s also, it seems like that's not going away. It looks like potentially it could expand to other places, and it has expanded. Those are also eligible for drawback. And Section 201 duties are eligible for drawback as well. In most cases, most drawback provisions, you can also get back your MPF, your merchandise processing fee. You can also get back your HMF, so that's your harbor maintenance fee or your harbor maintenance tax, and other certain commodity fees like the cotton fee. And in some cases, you can even get back excise taxes for example, for flavoring extracts, alcohols, perfumery, spirits, and wines. But what you can't get back through drawback are your anti-dumping duties, your countervailing duties, your any duties spent on over quota, for example, the over quota agricultural duties, and then the steel and aluminum tariffs of Section 232 are also not eligible for drawback. The drawback has been around. It's not a new concept. It's been around since 1789 as part of the Second Continental Congress. Part one, right after they established a way to fund the country through tariffs, they also put in place a mechanism to recover some of the duties. And the purpose of it was to do four things: increase global competitiveness. If you can get a refund of your duties, especially right now, it's, if you're paying 5% for the product, 25% for the 301 duties, you're looking at 30% of that commercial value being added into of duties. So being able to recover that and price it potentially 30% less could have tremendous advantages when you're trying to compete in foreign markets. The second reason that drawback was established is it can increase profit margins because it allows companies to balance the costs of importing and overall business with the recovery of the duties, the taxes, and the fees paid on the imported merchandise. So its intent is to help create and maintain jobs in the U.S. And it does that by helping to improve the profit margins that would allow companies to potentially hire additional workers and reduce unemployment statistics in the U.S. And with, as drawback, as claimants or clients of drawback have more and more duties to recover, the impact can be greater. So some of this stuff might not apply to some of the smaller drawback claimants, but certainly as we get up market and upscale, there are tremendous benefits to the drawback program. But really, the main point of drawback, and kind of at its core, what it started out as was it was designed to promote U.S. innovation and manufacturing. And it does that by enabling companies, by receiving a refund, to devote more resources to research, innovation, hopefully expansion, and thus promoting their own brand and contributing to the economic health of the United States. So there's a tremendous opportunity for drawback within the United States. At this point, there has been $2 billion paid into drawback, paid by customs to drawback claimants in the U.S. This year alone. And the estimates across the industry are that 70% of drawback goes unclaimed every year. That your companies and importers and exporters are leaving $4 to $5 or more billion on the table every single year. And so with drawback, I'm not going to say that it can cure everything, but it's a tremendous opportunity for companies to get a flow of cash back into their business to help drive down costs and improve business processes and everything that comes with that. So with that, I'm going to turn it to you and send you a poll. If you could take a minute to fill out the poll. And the questions here is, does your company claim duty drawback? So for some of you, you may already have an ongoing drawback program. You may periodically export, and once in a while you let your forwarder, your broker know, hey, I'm going to be exporting and I want to claim drawback. Some companies have never looked into it or are not really even sure if they qualify. And some companies perhaps know for a fact that they don't qualify. And what I want to say around this is, if you have an existing program, that's great. There's tremendous benefits to drawback, as we already went over. But if you haven't, or if you are looking to implement a program, the drawback regulations changed just over a year ago, or took full effect just over a year ago. And so there's tremendous new opportunities across the industry to realize more drawback opportunities, and we'll get into exactly what that looks like in a minute. I'll give you another couple of seconds here, and then I'll switch to the next slide to see the answers. All right. So great. It looks like there are 17% of you already do have a drawback program in place, which is great. One-off exports is certainly something that we're seeing a rise in. And, we want to encourage everyone to look into whether or not they do qualify for drawback and potentially investigate or implement their own drawback program. So thank you for taking time for that.
Hey, and Tim, just if I look at these numbers, this is very aligned with what you were just saying, is that, 60-70% of people don't benefit from the program. If you see here, no, we've never looked into it. No, we're not sure if we're qualified. That adds up to 60-70%. So it's very, very aligned with what you were just saying, and shows the opportunity for our clients here.
Yeah, absolutely. We definitely want to encourage, if it was up to me, I want every single company to, if you're exporting and importing, to claim drawback. Obviously, there are certain limitations. It is complex and all that stuff. So we'll get into that. But yeah, that's a great observation. It's really good to see the consistency, and interesting to see that as well. So on to the next slide. So right now we're at a unique place when it comes to imports and exports. We're seeing the steady growth of the values of merchandise. So we're importing pretty steadily, but what we saw in the last couple of years is duty rates have doubled just within the last couple of years because of the 301 duties. And that's placing more of a burden on our importers and our own economy, because we're spending so much more to get products into the US. If we look at the next slide, what we're going to see is looking at our export, because drawback is right, imports and exports. So it's the confluence of both. We're seeing 4x growth in the last 30 years of consumer goods. And the reason I wanted to pan out a little bit for this was because of something that has not necessarily negative impact, but has a more restrictive impact on drawback, and that's NAFTA and USMCA. And I'll get into exactly what that is in a little bit. But what you're seeing is we're importing more consumer goods since 1989. And then also there's a growth in export value since 2010 of 1.3x. So there is a steady growth in, we are importing more, but we're also exporting more. And 33% of our trade is going to Canada and Mexico. staying within North America. And that's that's troubling from from a certain drawback perspective, because if we go back to why drawback was put in place in the first place, it was there to promote manufacturing. But what we're seeing is more of an increase in importing consumer goods, not necessarily raw materials. And if we look at the overall growth as it relates to actual manufacturing, which is not on this slide, what we're actually seeing is within that last couple of years, manufacturing has exports of manufactured goods has gone down by 10%. So more companies are importing and exporting finished goods rather than importing raw materials, manufacturing in the United States and exporting finished goods. So let's look at now the paths to drawback recovery. There are two main types of approaches to drawback. The one is the one-off. So if you have sporadic exports, occasionally you're exporting, but not frequently enough to warrant a full drawback program, you usually go the first route. And what that sometimes looks like is you import something, it comes in, you accept it at your warehouse, your DC, you open up the boxes and it's moldy, or it's defective, or it's not quite what you ordered, and you're going to send it back. That is a common scenario that then lends itself to the first mechanism. Another is you import something in the US, you realize, or COVID hits, right? And you're just not able to sell it, and it's just sitting in your warehouse, and time goes on, and you're not going to be able to sell it, or you're going to have to destroy it because it's expiring. That's another opportunity for you to claim drawback if you're just not going to sell it, and it's just outside of the normal scope of what your business does. There's an opportunity to go through the first route. And so what that is, or what that entails, is customs submission, giving customs advance notice that I'm going to be exporting or destroying with the intent of recovering drawback on that particular action. Customs will then review the documentation that we provide them, and then either decide to witness or inspect, or they'll waive that requirement altogether. Once customs renders their decision on what they want to do, you go ahead and export and destroy, or export or destroy, and then we follow up once we gather the documentation to prove fact of exportation, fact of destruction, date, and all that stuff. We follow up with a drawback claim, which is a separate process altogether. Drawback claim is the submission of the data that validates and applies for the actual refund of your drawback. And then once we submit that, oftentimes your payment will come within 1 year, because a drawback is paid at liquidation. And customs can extend, as you know, liquidation up to 3 times, so up to 4 years. So with that, that's a tremendous opportunity for anything that's an exception to the process. For companies that are regularly importing and have continuous export volumes to various countries, what we do is, to have to file a customs form 7553 prior to every export could be a tremendous burden, and could take a lot of time, could very much delay your exports, or destructions for that matter. So what we do is we go down to the second one. There's tremendous benefits to it, but also it takes a little bit more time to set up. And that's the ongoing drawback program. And for privileged continuous drawback recoveries of past, present, and future imports and exports, this is where we go. And through this mechanism, we are able to claim back up to 5 full years of import transactions, the duties, the fees, and your exports. What we do is apply for a privilege. If you're a manufacturing client, or if you manufacture within the U.S., you have to go after a ruling. But aside from that, what we do is submit a drawback privilege application, not a right, it's a privilege. Drawback privilege application, which one allows you to waive the requirement for that 7553, going back in time, so you can claim on historic transactions or historic exports. And then, so that's the one-time waiver. And then the waiver of prior notice, which is the second part of that application, allows you then from today forward not have to file that customs form every time you export, and still preserve the opportunity to claim drawback. And then the third piece, which is the most interesting piece and the one that everybody cares about, is accelerated payment. And the reason that we all care about that is because you don't want to go through the process of preparing drawback claims and submissions and have to wait a year like you do for one-off exports. So you'll get paid under the accelerated payment privilege within 4 to 6 weeks from the day that we submit the drawback claim. But one thing to note about the privilege application is that it does take time. It's not a tremendous lift to put one together. It can be, but it generally isn't. And we submit that with customs, and they generally have somewhere between 90 days. But what we're really seeing right now is anywhere between 6 months and 12 months is how long they're taking now to process these applications. Sometimes less, sometimes more. But while that's pending with customs and while they're reviewing the documentation, what we do is start collecting your data. As we said, we can go back 5 full years on imports and exports. And oftentimes that's exactly what we do. We go back the full 5 years and pull everything we can and prepare it for drawback. We prepare the documentation, we get everything ready, and once we get the approval, or even before, depending on how old some of the imports are, we can go ahead and file drawback claims. And then ultimately, you'll receive your drawback payment. One thing to note with both of these scenarios, or more so with the second scenario, the ongoing drawback program, is you do have record-keeping requirements, just like you do as an importer, just like you do as an exporter, and basically as anyone who lives in the U.S., we have certain record-keeping requirements all over the board. But with drawback, if we're looking to receiving the payment does not indicate liquidation. We have to keep our records up to 3 years from the date of liquidation of a drawback claim. So if we go back, and remember, we can go back 5 full years. If we file a claim today, we can go back 5 full years. You can get paid in a couple weeks, but then, the claim will liquidate either 1 year, or they can extend it 3 times, so 4 years, and then 3 years. So 5 plus 4 plus 3, we're looking at 12 years we might have to keep import and export documentation. That's far and above what any other record-keeping requirements are. So just something to keep in mind here on that. And as we go on to the next slide, here we're going to talk about, yes.
Is it okay if I jump in here? So,
absolutely.
Hey, everybody. I'm Maryana, Kessel. I'm the sales director, and I just wanted to jump in very quickly on, one of the practical examples of doing a duty drawback. I have many, many clients that have gone through this process, and while it is complex and there are a lot of pieces to it, coming from a client's perspective, it is actually quite streamlined, especially if you're already a current Flexport client. I want to touch on 2 main things. The first is the data. As Tim has alluded to, every single piece of drawback relies on data fidelity and making sure that you have all of the data pieces associated both with the imports of those goods as well as the exports. And with Flexport, we have that natively included in our application. So any import or export you do with Flexport will have all of the data pieces required in order to create a drawback claim. So that makes it really, really easy for current Flexport clients to initiate that process. Now, if you don't already work with Flexport, I've been personally very impressed with Tim. This is not something that I, had experience with prior to working with Tim. And it's a really straightforward process. We'll work with your forwarders or your brokers to gather that data. We'll review it and audit it to make sure that all of the pieces are there. And that is that part that can take a little bit of time. But once you set this process up, what I found to be really helpful, and this is the second part, is that ongoing experience. So it is quite a worthwhile investment to be able to make sure that you have all of the data associated that you need. And once you set up that process, you can continue to do this annually. And ultimately, it is such a high impact process for your business. I think with this year, everybody is looking for any way to increase cash flow, and this has been a very high impact way to do so. So I just wanted to jump in more from a practical side, is that, working either with Flexport or, we can work with your current brokers to make sure that we have all of that data. The records are stored natively within Flexport as well. So that entire process is quite seamless, and it can be ongoing for you as well.
Yeah, great. Absolutely. And so kind of one more thing, I guess, to add to this that you kind of brought up, right? So everything that Red Square, the application process is a one-time thing. Once you're set up as a drawback claimant, as long as things kind of stay the same, you're not changing your name, you're not adding IORs, you're not, certain other things. A lot of the rest of it continues to be just, you import, you export, and as you continue to do that, we can continue to generate drawback claims for you, and you can continue to receive drawback refunds or payments directly from customs. One thing that we've seen have a tremendous impact on data fidelity has been the new product library, as it stores a lot of detailed information on products, which helps be the foundation for the source of truth that can then lead to more reliable data upstream that is necessary for drawbacks. So that's something that I wanted to point out here as well. So thank you. Looking at the various drawback provisions, so there's a lot more than this, but everything, if you just distill down the complexity of all the other drawback provisions, it can be boiled down to these three scenarios with some exception. Unused merchandise is exactly what it sounds like. Somebody imports something and exports it. Say, for example, you're importing a crib. You're importing a crib into the U.S. You bring it into your DC. You have a customer in Europe who wants the crib, and you export that crib out. That is a drawback eligible scenario. So there's two different types for unused merchandise drawback, and that's substitution and direct identification. I'll explain what those two are. Substitution is exactly what it sounds. You import one crib, let's say a white crib style XYZ. You have a customer place an order for a blue crib style 1, 2, 3. And they export the blue crib out, and you fulfill an order with the white crib or whatever. You can claim the export of the blue crib against the import of the white crib, as long as the import and the export share the same 8-digit HTS number, so the tariff number. There are some limitations to that, and I'll get into that in a second. But so how that's calculated? So if the blue is priced at a higher value or a lower value than the import, the calculation would be based on the lower value. So if the duty attributed to the import versus the duty that would have been attributed to the export, would it have been imported? So whatever the lower value of those two are, the duties and fees are assessed based on that. And the reason for that was more of a protective measure. Can you imagine, think at a high level, you're importing, there's different values for cars, right? There's the high-end luxury car, which could be money that I will never have. Most of us probably won't. And then there are those automobiles that are definitely affordable. Think of like your first car, right? The duty that would be attributed to the value of one of those luxury automobiles would be could be potentially tremendous. And if you're exporting something of a lower value, what customs didn't want was for you just to keep exporting low value cars, importing high value cars, and generating tremendous revenue on that. So what they did, and taking advantage of the intent of drawback in the first place. And so what they did was under substitution, you have to compare the value of the import versus the value of the export. And it makes a lot of sense for that. One other limitation for substitution for unused merchandise is if there's anything that's considered other or basket provision, meaning the 8-digit HTS number begins with the word other and the 10-digit HTS also begins with the word other, or if it's just one line other, that is considered a basket provision or a drawback basket provision and is therefore ineligible for unused merchandise substitution. And then you would have to fall to the next level, unused merchandise direct identification. And what that is similar to substitution. You import, you export. However, the import must directly be able to be linked to the export. So think of a serial number, a lot number, a batch number, whatever unique, not necessarily unique product code, but whatever unique identifiers on any unit of merchandise, we need to be able to track an import to its exportation. In lieu of, as many know, a lot of commodities don't have serial numbers. T-shirts, for example, a lot of consumer goods don't. Some electronics do, but a lot of consumer goods don't. So when there isn't that type of traceability, what customs does allow is an alternate way of identifying that type of merchandise. And that is through any type of alternate accounting method, something like a LIFO, a FIFO, a low-to-high blanket. So there's a bunch of them. But basically there are other ways to do it, but more documentation or more data and more reliable data will be required to substantiate that as well. So with substitution, drawback is calculated based on the entry line level. So we're not dealing, at least on the import side, we're not dealing with our commercial invoices. We're not dealing with our packing lists. We're only worrying about the values that show up on the entry line. So the quantities and the values. For direct identification, we are looking at the invoices. So we are designating at the invoice level. And that's where Flexport really has set up a tremendous program in their data capture, where we are able to capture the data in a way that down to the CI level, you're able to attribute the duties, taxes, and fees that are eligible for drawback, tie them all the way across as is necessary for drawback in many, many cases. And then moving on to manufacturing, with manufacturing is exactly what it sounds like. You're importing raw materials, you're manufacturing or producing or assembling something within the US, and then that finished product is being exported. With substitution, it works much in the same way, right? We're importing components. The components are being used to produce a finished good. The finished good is going out. So the substitution is based on the component of the bills of material or the bill of materials, and going to designating the 8-digit HTS number without regard for whether it's other, but matching the component of the HTS of the bills of material to the import, to any import. So as long as the component and the import share the same 8-digit HTS, you are able to designate that for drawback. With that, the same lesser of calculation is applied. So the standard cost or whatever GAAP accounting value might be attributed to that component versus the value of the import, whatever the lesser of those two are, that would be the value that would be used to determine the duty and fees that could be recovered. Direct identification, similar to unused merchandise, we would be directly linking or alternatively identifying the components that are used in production of a particular export. Going on to rejected merchandise. So with rejected merchandise, it's exactly what it sounds like. You bring something, so there's 4 different buckets for that one. So merchandise that is imported that is not conforming to sample or specification. So you order something, you get it, and it's like, this isn't exactly what I ordered. The buttons are the wrong color. So you send it back, right? That's rejected merchandise. So if you or your consignee receive something that you did not order or it was shipped without consent, that's also rejected merchandise. A common one, unfortunately, is defective at time of import. So going back to our mold example, you know, that's very common. And then returns from retail. And I want to pause for a second on returns from retail, because this has tremendous implications on 33% of our trade. As we said before, Canada and Mexico account for 33% of our exports, at least from a value standpoint. If we returns from retail is a specific type of rejected merchandise, but it does present challenges that could affect the drawback eligibility overall on exports to Canada and Mexico. And so at a high level, what returns from retail are and why it's a problem is returns from retail are anything that enters the market as being that is sold to a customer and customer. And so that could be as simple as, you know, fulfilling an online order. Right now, because stores are somewhat closed and a lot of e-commerce has boomed, there's more direct-to-consumer sales. If you sell to a customer, they open the box, they return it, there's an opportunity that merchandise was used, even if it was tried on, and then if it was re-entered into your inventory, and you don't specifically have control over which unit of merchandise that is, unused merchandise could be, you could disqualify yourself from unused merchandise. And unused merchandise direct identification is what is the only allowable method within reason. There are some exceptions, but for exports to Canada and Mexico. With that, I have another poll. So with this, there are a couple questions, right? So you can check any of these. If you import and pay duty or purchase from an importer who pays duty, this is an area where third parties might be importing, and you might still have the opportunity to claim drawback. If you are manufacturing using imported merchandise or similar merchandise, if you export or destroy imported or similar merchandise, as we said, similar being substituted, having the same 8-digit HTS number. If you export or destroy manufactured products, you don't have to be the manufacturer. Or if you sell to customers who export in the US, there might be an opportunity for you to claim drawback as well. So I'm going to give you another about 10 seconds to do this, and then we'll go on to the answers. All right. So definitely there seems to be a good amount of opportunity here. We import and pay duty or purchase from an importer who pays duty. This is extremely common, right? So there is duty going into your supply chain. You are being impacted by the duties. Some manufacturing going on, definitely some exporting going, 38, almost 40% of you are importing or exporting similar merchandise, or exporting, destroying manufactured products, which is great. And then some of you even are selling to customers who export. Those are all scenarios where drawback might be an opportunity. So when we look at third-party drawback, essentially there needs to be a commercial link between the import and the export. There is allowed substitution, as we mentioned above, in some of the earlier slides, but it is when third parties are involved, it gets a little bit more complicated, but it is certainly doable if enough of an opportunity exists and there's enough of a commercial link. So most of the time, the importer is the exporter. The importer might be the manufacturer and the exporter. Other times, the importer might sell to a manufacturer who might sell to an exporter, or any combination of those things. And there are opportunities for us to claim drawback across different companies or across different entities, as long as there is a chain of commerce between the companies. I think this is the last poll, just quickly looking at some complicating factors for drawback. So for example, our export shipments or our courier or parcel shipments, so these smaller direct to customer shipments often lack a little bit of traceability. Sometimes documents disappear off of some vendor's website. So that can present a challenge in proving date and fact of exportation. Having a unique identifier, such as a lot, batch, serial number, or a VIN, helps alleviate some of the record keeping or some of the details necessary to fulfill a drawback. It reduces the amount of data we need or you would need. It also improves the likelihood that retail returns could be tracked better. We sell within the U.S. and accept returns from those customers. Exactly. That's a complicating factor. That's something you want to be very careful about. If you sell within the U.S. and you accept returns from those customers and those returns could be sold, that is something you want to be very careful about and have significant control over. We destroy merchandise or contract a third party to destroy within the U.S. There are opportunities when a third party destroys for you. That's great, and we manufacture or contract a third-party manufacturer in the U.S. And so there are more requirements for those drawback types as well. The application process is a little bit different. There's more data, more documentation needed to substantiate drawback. But those are all scenarios that can complicate, but also having enough control over them can help facilitate the drawback process. So great. Thank you for answering that. And as we said, details matter. And it's very important to take note of what your supply chain is, how you guys are tracking inventory, and tracing your merchandise. Ensure that you are, take a look at your tariffs, make sure that you're able to tie the tariff or the census unit of measure to a product. Increase your record retention. As we said before, ultimately you could be claiming up to or have to be retaining records up to 12 years. Validate proof of export. If you're doing courier shipments or really any export, make sure you have sufficient proof of date and fact of export, but also who is the exporter of record. Revisit your returns from retail. So as we said, that can have a tremendous impact on your drawback recovery, especially if you're exporting to Canada and Mexico. And avoid basket provision classifications if possible, right? If you can keep it out of the others, you're able to simplify your drawback process and be able to match an export back to an import based on tariff number. And that's much simpler than having to get into direct identification methodologies. And so when you look into your own drawback opportunities, you want to mine and collect your own data. Get into ACE, or the automated commercial environment. Look at your import data. Look at your exports. Look at your business model and look at your vendors, your customers, and see what opportunities exist and create an additional forecast. And that's a simple, there's no perfect method to calculating drawback potential, but one way to get a rough idea is to calculate, how much duties have I spent in the last year? What's my percentage of export sales versus my overall sales? If we multiply those two, that's a high level, easy to quantify guess at what my drawback potential could be. And then again, connect with suppliers and customers. And for this, I'm going to turn it over to Maryana.
Perfect. Thanks, Tim. So Tim talked a lot about the complexities and the different nuances of drawback, but I want to speak a little bit more to the overall high-level picture. While it is complex and there are these nuances, at the end of the day, it actually is quite easy. It can be fast, and ultimately it is high impact. So to talk about those three parts, in terms of the ease of it, when you are going to be working with Flexport through this process, Tim and his team, as well as your account team, are going to take care of things end to end. And I think most importantly, having a project timeline is critical, right? We're ending the end of the year. We're going to be looking into 2021. And what is this really going to take? And when can you provide your team and your company updates on a potentially very high impact cash drawback? So that's something that we're going to be providing for you from day one. Additionally, as Tim mentioned, you can do this back of the napkin kind of map on your own, but we do have additional ways and resources to give you more of a closer estimate to what that drawback potential could be. And again, this is something that will help you justify your resources and your time in deciding to move forward with this program. When it comes to the speed, while customs will take their time, between those 6 to 12 months, that's something that we do in parallel with gathering the data, doing those audits, and making sure that things are ready to go once that privileged approval comes in. I can speak from experience. I've had many, many clients, kind of hitting that refresh button every day and seeing when that privileged approval will come in. As soon as we get that green light, it's essentially next day that we're going to be able to transmit those processes as we're working in parallel. So with regard to the speed, again, this is something that is material. It is something that you can forecast. So I wanted to make sure to mention that it is critical for business processes. And last, but certainly not least, I'll continue to say the high impact nature of this program. We've had clients where it's, tens of thousands of dollars all the way up to, hundreds of thousands or even higher. And that's going to depend on, again, that balance between your imports and exports and, of course, your duty amount. But it is something that is material and it's substantial. So, from my perspective, when we're encouraging our clients to think outside the box or, ask the $30,000 questions and not the $3 questions, this is certainly a topic that we talk to almost every single client that does that import and export process. So the last thing that I'll say again is overall, this is a complicated structure. However, with Tim's team and of course your account team at Flexport, this is something that we take care of end to end and we really hold your hand through. So I've been really impressed with the speed and really seeing that benefit come through for our clients. I think this is the last slide, and we're going to head to Q&A. We have hundreds and hundreds of folks on, and I think we have nearly 30 or 40 questions at this point. So I want to turn it over to Sanne to moderate.
Yeah, and it's great to see the engagement on the questions. We didn't expect so much engagement on this topic, so we won't be able to answer all the questions, but we will give it a fair shot. We have another 11 minutes, so let's go. So I think quite a few questions are about what is the type of assistance that Flexport offers to make claims for duty drawback. And I think there are quite a few questions that are about how do we set this up. Maryana, is that something that you can, you've already touched upon the topic, but how do we make this practical for our clients?
Certainly, I can definitely kick that off. So the first step is to reach out. You can reach out to Flexport either, if you're not a current client, to our website, or if you are a current client, just to your account manager, either your account executive or your customer success manager. We're going to be able to take you through that process, and we can give you pretty quickly an idea of whether or not, your company would be a good fit for drawback. So that is just as simple as reaching out, and then we'll have probably a 30-minute call with Tim and his team to understand the data backbone. And then from there, we'll be able to give you an estimate. So it is quite simple.
Hey, and just to confirm, that estimate is free, right?
Correct. Yes, it's completely free.
Great. It would also be great because we get quite a few questions around it. It's like, what makes sense for a drawback recovery? Is there a minimum drawback? What are the fees that are associated to it? What does the financial picture look like, and what have you seen from your experience? And I think let me start with Maryana, and let Tim chime in there.
Certainly. So the one, kind of phrase answer to this is that it is going to be customized. When it comes to whether or not it will be worth it for you, I think that really is a discussion that we have with each and every client. Certainly if it's, in the hundreds of thousands of dollars, anybody can tell you that, yes, this is a worthy, process for you to go through. But we've even done duty drawbacks for, the 10,000, 20,000, 30,000 range as well. And again, I think it's going to be a discussion with, every single client of what is that data structure that you have today. If you've been working with Flexport, it's all there ready to go. So of course, that's a very easy way to say yes. If you haven't, we'll need to see where those records are and how much investment that's going to take from your side to really gather all of those pieces. And as Tim alluded to, there are many, many sections that are needed. So that is probably the biggest question of whether or not this is worth your time. But again, this is something that is customized to every single client. We take a very tailored approach, and we'll work with you to figure out if this is something that's for you. Tim, is there anything you want to add?
No, I think you're absolutely right. So not every program or not every opportunity. So some drawback opportunities at 100,000 or 100,000 in recoveries might not be worth it, but another opportunity at 20 or 30,000 might be worth it because of the complexity or the lack of complexity. So it really does matter about what types of drawback provisions we're looking at, how readily available, as you said, the data and the documentation is. But generally speaking, 30,000, you want to hit 30,000, and then above that, we can have a conversation. I think even below 30,000, let's have a conversation and see if we can find a simple solution that makes it worthwhile.
Yeah. Hey, and maybe following on that, when you initiate this program, I think one of the big questions is when do I get my money? And I think that's also again an answer of it depends. But can you give a little bit of guidelines there?
Yeah, I think so. A lot of that depends on customs, to be honest. So we work really fast. Right when you come to us, our first objective is to get that privilege application as was part of that second scenario. We work really fast to try to get that application completed and filed, because once it's sitting at customs, it can be there quite a while. So what we generally say is, if you're reporting up, don't tell them that you're going to get refunds for up to a year. Hopefully we're able to shock and awe, the executives above you and get it sooner. But what we don't want to do is set unrealistic expectations that are beyond our control.
Yeah, and that's because it's in the timeline at customs is just long, right?
Right. Yes.
If you have a program, as you already mentioned, if you have a program set up, it's much more like 6-8 weeks. But if it's a one-off, then it takes up to a year, right? Yeah. Great. Yeah. Are there any limits on time limits on when you can apply? If I exported something 5 years or 6 years ago, where's the limit?
Yeah, so the limit is, if we file a claim today, we can go back 5 full years on imports and exports. But if you come to me today and you want to claim on something that was exported in 2015, we're probably not going to get everything filed in time to get. It's just probably not going to work. So give it a little bit of a buffer, but generally you can get back 5 full years on imports and exports.
Yes, there are a lot of questions here around B2C shipments, so direct-to-consumer shipments. Are those eligible as well for duty drawback, or is it only B2B shipments?
Yeah, so as long as it's being exported, it is eligible. It has the opportunity to be eligible for drawback. I think where B2C has its own challenges are around the returns, and particularly around the proof of export. As some of the carriers they don't have the same record keeping requirements or standards that are necessary to, or often helpful for drawback to help prove date and fact of exportation. It's possible, but it can be a challenge.
Hey, Tim, a very specific one here, but it's asked by multiple people. What about inventory held and destroyed by Amazon? Is that eligible, and is there special documentation and requirements that I need to file?
Yeah, so destructions are eligible when it's performed by a disinterested third party. Generally, that's by destruction facilities or waste management companies. Having businesses like Amazon or somebody else destroy something is likely not a drawback scenario. But if there are specific examples, we can also talk about that offline. But at a high level, it does not sound like that in particular is a scenario eligible for drawback. But if you are destroying using a actual waste management or other type of destruction or waste facility, that should be eligible.
Okay, so the big question here is for the folks that ask these questions is like, most likely Amazon is not destroying it themselves, but they're sending it to a destruction company. Is there any, let's say, documentation there that proves that, right? So for those people that ask those questions, please reach out to us. We'll be happy to help you here in that process. Let me see here. How frequent do U.S. Customs audits? U.S. Customs audit a firm's duty drawbacks that have been claimed? Are some firms more susceptible to audits than others? And if so, what are these factors? In other words, are you at a higher risk when you're claiming duty drawbacks for audits? Or most likely there is no correlation, but I'd like to hear your opinion there.
Yeah, I mean, it is a regular function of customs to audit drawback claims. It is luck of the draw most of the time. When you file your first drawback claim, you will be, or you should be, issued a first claim letter, which is the customs terminology for a nice little desk review for your first claim. So every claimant should be getting audited on your first claim. It's a light audit, and as a broker, we do a majority of the work on that. But generally speaking, drawback audits are rare. They're not. You can get them, but generally, it's not very common. But it's just like import. Luck of the draw.
Yeah.
I'd love to add a comment here as well. I know that audits in general can, even thinking about it, can cause quite a massive amount of anxiety. What I'd like to say here is that in practice, should that happen, all of the documents are associated directly within Flexport. You can download them at any point in time, 24/7, for any time looking back that you work with Flexport, as well as the product library and the SKU. So any SKU, any HTS code, any changes that have happened to that, there is an audit log there as well. So I would say that should that occur, you do have all of the data that you need already, readily available within the platform for you. And that's certainly something that we help our clients through.
Great. We get a lot of questions about Canada and Mexico, and for exports to Canada and Mexico, and whether substitution drawback, can we do substitution drawback for export to Canada and Mexico? And there's also a question specifically about, do we have to use a direct ID? This is above my pay grade, but Tim, you probably understand exactly what's meant here.
Yes. So this could actually have its own 4-hour webinar just on Canada and Mexico. Because of NAFTA and USMCA, there are tremendous limitations. So there are substitution carve-outs for orange juice, for certain quilted goods, some other like really specific things. But overall, and potentially originating goods for certain types of merchandise as well. But generally speaking, you have to directly identify that merchandise. So either through that serial batch lot identification or an alternative accounting method. So that's the first requirement. The second requirement is that it must be in the same condition as was imported. And so that means unused. And one of the things was retail returns disqualifies you from unused merchandise, and therefore Canada and Mexico are off the table. Also allowed is manufacturing to an extent. If you're importing raw materials into the US, you're manufacturing, you're exporting to Canada or Mexico, you're allowed the lower of 2 duties. And generally speaking, when you manufacture in the US, you don't pay duties into Canada. You don't pay duties into Mexico. So the lower of would be 0. So technically you could, but there's nothing to recover. But there's a lot of more nuances. If there's specific questions, do reach out. We'd be happy to answer those.
Yes. Can we talk a little bit more about if there's any specific guidelines around donations? Does a donation has to be a nonprofit, et cetera, et cetera?
You mean donations for export?
So in general, donations of product, are donations eligible for drawback, and what is the regulation around that?
Yes. So there isn't particular carve-outs for donations. Again, it's if you're donating and it's being exported, as long as it meets the requirements of the other drawback provisions, as long as it's going to someone else, or if you're the one that is the US PPI or the one arranging the export, there's an opportunity there. I think I'm not sure I understand the scenario enough to get exactly at a yes or the answer, but it should, if you're exporting, be eligible for drawback, as long as it's not like we're donating used shirts, right? It would be new shirts or something that fell into scope.
Okay, great. Well, we're at time, and we've only got to a third of all the questions. So we will be going through all these questions and see what we can answer offline and directly reach out to you. What I'd like to do before we end today, you will find a copy of the slides at the bottom left of your screen. An on-demand version of the webinar will be available shortly after the webinar. So I realized this was pretty technical. So there is another opportunity to see Tim and Maryana and live through all the details. Special attention for the 2 webinars that are upcoming. There is a State of Trade on December 15th. This will be a discussion between our CRO, Will Urban, and our Chief Economist, Phil Levy. So it's a discussion between Will and Phil. It sounds like a rock band. It's probably going to be like a rock band. So that's going to be super interesting. And then on December 17th, there is a freight market update webinar on the UK. I would also like to draw your special attention to this. The UK is in a total freight meltdown. The ports are having only half of the throughput. Carriers are calling force majeure and are refusing to sail there anymore. This is a big issue in global trade, and this is even before the Brexit starts. So I would highly recommend you to be there. Well, thank you so much for joining. Thank you so much, Tim. Thank you so much, Maryana. This was super insightful. I even learned quite a bit, and looking forward for you all to see you again at the next webinar. Thank you.